The Fed hikes rates and the market crashes. Let's have a look. Hello everyone, Florian here, and welcome to another episode of HeiseSays. Grab your stein of coffee. Let's have a look at an article discussing the Fed increasing rates by 75 basis points. Not a surprise to anyone. If we jump over here, we can see, well, the expectations were an increase to 3.25 by Trading Economics and the consensus. And we can see here in the chart, this is the maximum chart they have, this is a pretty sharp increase in interest rates. Last time we saw such a sharp increase, I'd say, back in the 80s, guys. If you look at all the other, back here in the 90s, not quite as much. No, that was not as drastic. But there you go, guys. They're trying to tackle inflation. And the stock market is not liking it. We can see here the S&P 500, it's down. We look at the 5-day, the 1 month. Let's look at the year-to-date. We're down 20% on year-to-date. And, well, the Australian markets, we're behaving pretty well because, well, we've got the Queen's holiday today. And one more thing, if we have a look here, let's check out the Aussie dollar to the US. It's also down to 65 US cents. So there you go, everyone. And if we jump out, hang on, we'll go 25 years. Yeah, we're heading down, guys. Last time we were around this level was in 2008. Before that, remember when it was 40 cents? 40 cents? Remember when it was over $1, guys? So where's the Aussie dollar heading? Because remember, the lower this goes, the more attractive our exports are, but also the more expensive all of our imports are. And we all know that Australia is a very import-dependent country, particularly, well, all of our construction materials. So the lower this gets, the more expensive it's going to be to build houses. And we already have a housing shortage as well, so isn't that going to be awesome? So let's have a look at this, guys. The US Federal Reserve hikes interest rates by 75 basis points, or 0.75%, despite recession fears. Now, we probably will be heading into a recession. The United States has again aggressively hiked interest rates as central banks around the world respond to surging inflation. But one thing we need to keep in mind, the traditional inflation hedges, let's jump back here to trading, of gold, precious metals. Gold is not doing too well. Silver's not doing too well. The newfangled ones, Bitcoin, is not doing too well either. You can see here gold, 1658, guys. It's just tanking. It really is just tanking. It's, hang on, we'll go, there you go. Look at that. Where are we heading down to 2015 levels, guys? You've got silver as well. We'll have a look here. 25 years. It's staying pretty flat. It's not getting up over that $30 mark, is it? Jumped up in 2020. Yeah. And Bitcoin, well, yeah, it's heading down. 18,776. It's settled below 20,000. It's trying to fight it. Where's the support level, guys? We're below the last peak. So you tell me. Remember when they used to say it was a non-correlated asset and people were buying this as an inflation hedge? So let's have a look here. US Federal Reserve imposed the latest in a series of sharp interest rate hikes on Wednesday, in a sign that policymakers aren't backing down from an aggressive campaign to lower decades-high inflation. The rate-making Federal Open Market Committee hiked the nation's benchmark interest rate by 0.75% or 75 basis points at the end of a two-day meeting. The latest increase moved the Fed's target range to between 3% and 3.25%, according to the New York Post. Central banks around the world are hiking rates quickly in response to burgeoning inflation, which the World Bank has warned could trigger a global recession in 2023. Fed Chair Jerome Powell acknowledged that the rate hikes could contribute to declining activity of all different kinds in the U.S. housing market and were likely to cause relatively modest increases in unemployment. U.S. Senator Elizabeth Warren slammed the move, describing the move as an extreme interest rate hike. I've been warning that the U.S. Federal Reserve Chairman Jerome Powell's Fed would throw millions of Americans out of work. and I fear he's already on the path to doing so, she wrote on social media. We can see here all the other reserve banks. Hike. Where are the cuts? Japan and China. There you go. Is that New Zealand? Are they? No, one. The CPI. Okay. There you go. A table posted on social media by Compound Capital Advisors CEO Charlie Bellio shows in stark detail how central banks around the world are responding to inflation by hiking interest rates. The World Bank said central banks were moving with a degree of synchronicity not seen over the past 5 decades, as it warned of an economic crisis. China, Japan, and Russia are among the few countries to cut rates recently. So more rate rises are expected. And you've got to understand this is going to have an impact on probably the people that have bought in the last 2 years. Those of us that have bought further along, we'd have, and mortgages won't be as high. But remember, here in Australia, the housing market's been juiced up. In a statement after the meeting, the FOMC said it anticipates that ongoing increases in the target rate will be appropriate, an indication that the Fed isn't done hiking interest rates. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low, the FOMC said. Inflation remains elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. Fed officials have now hiked the benchmark rate by 0.75 of a percentage point for 3 consecutive meetings. The 0.75 point hikes are the first of their kind since 1994, an indication that the Fed's urgent desire to bring prices lower. Speaking at a post-meeting conference, Mr. Powell said the FOMC would hike its benchmark rate to a restrictive level and keep it there for some time. Current Fed projections call for a 4.25% to 4.5% rate hike by the end of the year. My main message has not changed at all since Jackson Hole, Mr. Powell said, referencing a hawkish speech he delivered at the Fed event last month. The FOMC is strongly resolved to bring down inflation to 2% and will keep at it until the job is done. The Fed signaled it expects inflation tracking in the Personal Consumption Expenditure Price Index, its preferred gauge, to fall to 5.4% by the end of the year and reach its 2% target by 2025. Do you trust them? Remember when everyone was saying, every man and his dog, that inflation was transitory? Remember that? So unemployment expected to rise in the US. This is going to hurt a lot of people. The median projection among Fed officials showed an expectation that unemployment could rise to 4.4% by the end of 2023. As of August, the unemployment rate was at 3.7%. The Fed would look for several key signs, including below-trend economic growth, better balance between supply and demand in the labor market, and compelling evidence that inflation was falling before considering a pivot. Prior to the FOMC's announcement, investors were pricing in an 82% probability of a 0.75 percentage point hike and an 18% probability of a full point hike. Yields on 2-year Treasury notes spiked above 4% on the expectation of another hike. The Fed was widely expected to implement another sharp rate hike following a dismal August consumer price index that renewed fears about persistent inflation. That's despite mounting fears among investors that the Fed will be unable to achieve a soft landing and will instead tip the economy into a recession with its policy tightening. Stocks have touched fresh lows in recent days as investors brace for an economic downturn. The Fed's benchmark interest has direct and indirect effects and ripples throughout the broader economy. Hikes impact credit card interest rates, savings accounts, auto loan, and other forms of borrowing. They also influence mortgage rates, which have surged above 6% for the first time since 2008 and have triggered a slowdown in the housing market. Some critics, including billionaire Elon Musk and bond king Jeffrey Garland, argued the Fed risks causing destructive deflation by continuing forward with rate hikes despite signs of a slowing economy. The Federal Reserve is likely tightening policy straight into the teeth of a recession. Many stock investors are hoping for a dovish pivot, but the stock market's addiction to Fed easing when stocks decline may be what Jerome Powell is aiming to quash by aggressively hiking rates, in addition to inflation, said Quell Intelligence Chief Executive and Chief Strategist Daniela DiMartino Booth. Prices rose by hotter than expected 8.3% in August, while core inflation, a measure that excludes volatile food and energy prices, jumped by 6.3%. Inflation is much higher than the 2% range that the Fed and the Treasury Department deem acceptable. The troubling Fed data led some analysts to predict the Fed would implement a full-point hike for the first time in several decades. Even before the August CPI was released, top policymakers, including Fed Chairman Jerome Powell, were indicating aggressive rate hikes were in store for the U.S. economy. During a speech early this month, Powell acknowledged the Fed was aware of the risk of prematurely loosening policy. He added, "The central bank was strongly committed to this project, and we will keep at it until the job is done." Powell has warned that hikes will continue even if it results in some pain for U.S. households, including increasing unemployment. In a separate address, Federal Vice Chair Lee Bernard said officials were committed to tightening policy conditions for as long as it takes to get inflation down. So the RBA continues rate hikes into 2023. Meanwhile, Australian homeowners have been warned that interest rates will likely continue, or interest rate hikes will likely continue. In September, the Reserve Bank of Australia increased the official cash rate by 50 basis points to 2.35%, and its fifth hike this year. Remember when the media was reporting our very own Reserve Bank Governor Philip Lowe saying rates wouldn't increase until 2024. And that was only one of the scenarios, and there were a whole lot of conditions there, but most people didn't hear it like that. You have people that took that as face value and ran with it, and they're learning a tough lesson. So, currently interest rates are at their highest level since December 2014, with the most recent rate rise marking the first time it's been above 2% since April 2016. However, economists believe the worrying trend will continue. Westpac chief economist Bill Evans forecast another 0.5% rise in October before the RBA slows to 0.25% hikes in November, December, and February. So, another 1.25% up. There you go, guys. I mean, none of us expected these rates to stay this long forever, did we? But you can't blame people for thinking, oh yeah, it'll stay this level at least till 2023. Nope. Clear evidence of the expected slowdown in inflation will not be apparent until late February, allowing the RBA to go on hold in March on evidence that growth is slowing and that inflation and rates have picked up in the US, he said. So there we go, everyone. Let's have a talk about this one. So how much damage is the Fed going to do to the economy to try and get inflation under control? And what's that going to do to the US dollar? What's that going to do to the Australian dollar? And how's that going to impact our economy? I mean, if the dollar keeps going lower compared to the US, that means, as I said, all of our building materials are going to get more expensive, and that's what most spec houses are built. What's that going to do to our property prices or to the supply of property when we've got an increase in immigration and you've got an increase in international students returning to Australia? But we also have a construction apocalypse going on now where builders are going under left, right, and centre. So our ability to address demand and provide increased supply is also going down the toilet. This is the thing, guys. Economics is a complex emergent system with a multitude of variables, and you get people trying to model and simulate and test, and the Reserve Bank just pulls one or two levers and tries to manage it. Now the question is it worth allowing them to do that, or would it be better to have a system where they just let the market and the invisible hand dictate what happens? I can't imagine Australians would be brave enough for that, but at the very least it's something to consider. So guys, I mean, what do? Are you worried about your investments crashing down? Do you think the Aussie dollar will continue to sink? Will that force the RBA to lift up rates to kind of maintain the strength of the dollar? It's going to be interesting. But here's one suggestion I would have. Make sure you've got a diversity of income sources. And this is why I've been buying shares in US companies. I don't really care about where they're going. I want to get an income stream in a non-Australian currency. Anyway, guys, thanks for watching. Check out my other channels, and hang on, I'll press the button here, HeiseBim and HeiseSays International for other content I discuss. And if you want to support the channel, there are a few ways you can. Financially on YouTube or Patreon, use our referral links at Amazon, eBay, Independent Reserve or AussieBroadband, buy our Pocket Squares or call us if you need an architect. Take care, everyone. Have a great day, and I'll see you next time.